Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. This week, we're doing something unique with the podcast, and then I'm offering a series of interview previews for interviews that will take place in the DIY Investing Summit next week, which begins Monday, January 23rd. And the summit is being put on in partnership between Seeking Alpha and Investor in the Family, and each one of these interview previews stands alone in its value, but it gives you a glimpse of what the rest of the interview may be like, as well as the rest of the summit, which overall has 25 interviews from some of the top investors from Seeking Alpha. Registration for the summit is free for a limited time, so be sure and check it out at DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can check out any of the links in the show notes or the article. I hope you enjoy this interview excerpt with Dividend House. How would you summarize your investing philosophy? And then specifically, how does that look as you build your portfolio? You've already addressed this a little bit. You've talked about why you focus on dividend and growth stocks, what they are. You talked about your foundations of the dividend aristocrats and the walls of companies who have grown their dividends 10 to 24 years. And then the roof companies who have less than 10 years of growing their dividends. And so kind of build the house out that way. But do you, what percentage of your portfolio do you dedicate 40% to the foundation, another percentage to the walls? How does all that work out?
Okay, yeah. So just to summarize, I think of myself as a financially conservative, do-it-yourself, buy and monitor, long-term dividend growth investor. That's a lot of adjectives there. But I would prefer to purchase dividend stocks and hold them forever. But I do make mistakes, so I do find from time to time I have to sell. It's either to correct a purchase mistake or when a stock doesn't perform as planned, or when I evolve my thinking as an investor. So just to summarize, since I plan to never sell a single stock, significant capital appreciation is not my primary objective, although I sure hope it comes along for the ride. But instead, I'm looking for DGA stocks with stable and growing dividend income streams that will cover my expenses in retirement. So you're right. I do think of my portfolio as a dividend house with the foundation, the walls, and the roof. I would like my foundation to be generating at least 50% of the total portfolio income. So that's how I think about it. I would like the walls to be somewhere on the order of 25 to 30% of the portfolio income, and the auxiliary stocks, the roof, to be somewhere on the order of 10% of my portfolio income, maybe to 15% of my portfolio income. There are two other categories, and that is I do have my doghouse stocks, and those are those stocks that, for whatever reason, they've fallen out of favor with me. So in some cases, it's my fault. I made a mistake purchasing them in the first place, and they're underwater, so I'm not willing to let them go. In other cases, they've underperformed, like Walmart and Tupperware have. And then the last category that we haven't talked about is I also have a garden to my dividend house, and my garden is where I've got my speculative stocks. Now, they're still dividend growth investing stocks. I don't have any stocks that don't pay a dividend. Even the ones in my garden are dividend growth. But these are the low dividend yield but higher growing stocks. So my biotechs are there. I've got Comcast there. So these are stocks that I think will grow faster on a capital appreciation side than normal, than my normal dividend stalwarts that are in my house providing me shelter. So they do typically have lower yields. So I'd like those speculative stocks to be 10% or less of my portfolio. That's really kind of roughly how I think about it. It's constructing the whole thing.
And so you look at it as far as so you want your foundations to be at roughly 50% of portfolio income. You said roof 10%. How much did you say on the walls again?
Yeah, roof can be 10 to 15%. Again, these are guidelines. So, and then the walls were like 25 to 30%.
Gotcha.
Yeah. And all these numbers.
No, it's good. I'm just trying to make sure I get them all down here in my notes. And so you mentioned, which is interesting because most people look at percentage in terms of a weighting for the portfolio, but you're looking more at the income that they're producing, which is a kind of a different angle than you normally hear.
That's right. That's exactly right. Yeah, no, I'm glad you pointed that out because I'm not sure I made that clear. But yes, I think about my portfolio as 100% of my income that's generated out of it. So what percent of my income needs to come from which area? And of course, the foundation stocks are my most stable, most conservative, most the stocks I have the most confidence in. So I want them producing at least half of my income. And I wouldn't mind if they produced, 60% of my income.
Well, tell me this. So what is, going back to a weighting of portfolio, what percentage would you say is the biggest position you have? Like 3%? Or what do you think that is?
Yes. I have a portfolio guideline that no one stock should be contributing more than 5%. So again, this is going to depend on how many stocks you have. My portfolio right now has 63 stocks in it. So, so having any stock not exceed 5% is easy to do because 5% would be 5%. If I had every stock equally weighted, I could only have 20 stocks. 20 times 5 is 100%. So, right. So no one stock can be more than 5%. That way, no matter what happens, if a stock does go out of existence, it's 5% or less of my portfolio. So again, of my income. So again, when I'm in retirement, I can cut back 5%. I don't have to cut back, 20% to if one stock goes under, let's say. So I do have that as a guideline that no one stock. So let's see. So you asked a question. So my largest stock right now, and let me just look. I've got my portfolio pulled up here, and I'll just look and see what happens to be my largest one these days in terms of income. And let's see, just sort this by highest to lowest, and I can tell you. And so my largest one is, I have this in the cloud, so it takes it just a second to...
No problem.
To come up. But yeah, so my largest stock is providing 4.1% of income, and it's Verizon.
Wow. Okay. Excellent.
Yeah.
Great.
Yeah. And Verizon is one of my foundation stocks. And it's providing 4% of the income of my portfolio. So it gives you an idea. I haven't gone against in fact, AT&T is my number 2 stock at 3.7%. So you can see I'm not getting too close to my
upper threshold.
Threshold, which is good. Yeah. I don't want to be too close to it.
I hope you enjoyed this excerpt from the DIY Investing Summit. If you want to hear the rest of the interview and the other 24 interviews from the summit, be sure and visit DIYinvestingsummit.com. That's DIYinvestingsummit.com, or you can click any of the links in the article or show notes to this episode, and it'll take you straight to the registration page. And remember, the summit begins Monday, January 23rd. You can still register after that, but you'll miss some of the content. So register by Monday, January 23rd at DIYinvestingsummit.com, and I'll see you there. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.